The current economic downturn has left many small business owners with less cash to pay off their debt obligations. The following case study demonstrates a combination of strategies that small business owners can use to manage their cash flow and taxes more efficiently in order to quickly pay down their debt and build wealth. Here we have Joe the plumber, who is 40 years old and currently earns $250,000 a year from his plumbing business. Joe's assets consist of a home worth $400,000, and he has $10,000 in his bank account, $10,000 in stocks, and $200,000 in his 401k. Joe also has considerable debt, including a $216,500 mortgage, car loans of $35,000, $15,000 in credit cards, and a business loan of $50,000. Joe currently pays out $3,000 a month to cover all his debt payments. In order to reduce this large debt obligation and increase his monthly cash flow, Joe is going to consolidate his $3,000 a month in debt payments into one lower cost payment of $2,000. In this example, Joe refinances his current mortgage of $216,500 into a 30-year fixed mortgage of $316,500 and then uses the $100,000 cash out to totally pay off his car loans, his credit cards, and his business loan. As a result, Joe's only debt obligation now is his new mortgage. Plus, he now has $1,000 a month more in cash flow after paying off that other debt. Joe is also going to use some available tax strategies in his business to lower his tax liability and increase his cash flow. In this example, Joe will install a health reimbursement account to cut his taxes by $2,500, add a health savings account to cut his taxes by $1,000, hire his child in his business, which will reduce his taxes by $2,500, use a strategy to eliminate his alternative minimum tax of $1,000, and gift and lease back his business equipment to save $3,000 in taxes. In the end, Joe will cut his taxes and increase his cash flow by $10,000 a year using these tax strategies. Now let's look at the results Joe can get by managing his taxes and cash flow a little bit better. By consolidating his debt and reducing his taxes, Joe has now freed up an extra $22,000 a year in cash flow. If Joe uses this extra money each year to pay down his $316,500 mortgage, he will own his house free and clear in a little over 9 years. At that time, Joe will be 49 years old and completely debt-free. Now, if Joe wants, he can invest the extra $22,000 a year in addition to the $2,000 a month mortgage payment that he will no longer be paying. That's $46,000 a year in extra cash flow he can invest. If Joe earns a rate of 5% on this extra money, it will grow to over $1 million in 16 years when he's 65 years old and ready for retirement. As a small business owner, are you giving more of your hard-earned money to the IRS and to your banker than you'd like to be giving to them? If so, there are many unique strategies like this one that you can use to build wealth.